How money is created out of nothing. What people think money is. Most people believe they understand what money is. They see it every day. They earn it, spend it, save it, and worry about it. To most people, money feels physical. It feels real because it appears as banknotes, coins, or numbers on a screen. And because it feels real, many assume it must be limited. A common belief is simple. Money exists because someone printed it. If there is more money, someone must have created it somewhere, usually imagined as a government or a central bank running printing presses. This belief is intuitive. It feels logical, but it is also deeply incomplete. In reality, the modern financial system does not operate primarily on physical money. Cash plays only a minor role in how economies actually function. Most money never takes physical form at all. Yet the idea that money is something produced, like gold, oil, or manufactured goods, remains deeply embedded in how people think. This misunderstanding shapes how people view banks, debt, inflation, and crises. To understand how money is created out of nothing, we must first understand why our intuition about money is misleading. Money as an object. For most of human history, money was something tangible. Coins were made of metal. Gold and silver had weight, texture, and scarcity. Even early paper money represented claims on something physical. Because of this history, people learned to associate money with objects, something you could hold, something you could store, something that could run out. This mental model still exists today, even though the system it came from no longer does. When people imagine banks, they often picture vaults filled with cash, rows of safes, stacks of banknotes waiting to be lent out. But this image is mostly fictional. Modern banks do not lend money that already exists in vaults. They do not wait for deposits before issuing loans. And they do not operate like warehouses for cash. Yet the warehouse idea persists, and it creates confusion about how money actually enters the economy. The illusion of scarcity. Because people think of money as a physical object, they naturally assume it must be scarce. If someone has more money, someone else must have less. If banks lend too much, they must eventually run out. This zero-sum thinking feels natural. But modern money is not a fixed pool. In today's system, money behaves more like a dynamic network of balances than a pile of objects being passed around. New money can appear, and it can disappear. This is not magic. It is accounting. But because accounting is invisible to most people, the process feels mysterious and often suspicious. Why printing money feels like the answer. When people hear about inflation, government spending, or bailouts, they often say the same thing. They're just printing money. This phrase has become shorthand for everything people distrust about finance. It suggests irresponsibility. It suggests manipulation. It suggests that money is being created recklessly, without consequence. But while central banks do create money, physical printing is only a tiny part of the process. Most money is created digitally, without printing presses, without trucks, without vaults. The real mechanism is quieter and far more powerful. The gap between experience and reality. In everyday life, money feels simple. You check your balance. You make a payment. The number goes down. From this perspective, money looks like a thing you possess, a quantity that belongs to you. But from the perspective of the financial system, your money is not an object. It is a claim, a promise, a liability on someone else's balance sheet. This distinction is crucial because once money is understood not as a thing, but as a relationship, the idea that it can be created out of nothing begins to make sense. Why this misunderstanding matters. Misunderstanding money leads to misunderstanding everything built on it. Debt begins to look immoral rather than structural. Banks appear predatory rather than systemic. Crises feel like accidents rather than consequences. People ask the wrong questions because they start from the wrong assumptions. They ask, where did the money go? Why can't we just save more? Why can't governments behave like households? These questions feel reasonable, but they are based on a model of money that no longer applies. To move forward, we must let go of the idea of money as a physical substance. Only then can we understand how modern money is created, expanded, and controlled. A transition to reality. In the next chapter, we will move beyond intuition and into structure. We will examine what money actually is in the modern financial system. Not as a moral concept, not as a political symbol, but as a functional mechanism. Because once money is seen clearly, its creation no longer looks mysterious. It looks inevitable. What money actually is. If money is not a physical object, then what is it? To answer this question, we must step away from everyday experience and look at money from the perspective of the financial system itself. At its core, modern money is not a thing. It is a record. More precisely, money is an entry in a ledger that represents a claim and an obligation at the same time. This may sound abstract, but it is the foundation of everything that follows. Money as a record, not an object. When you look at your bank balance, you are not looking at something stored for you. You are looking at a number that represents what the bank owes you. From the bank's perspective, your balance is a liability. From your perspective, it is an asset. This dual nature is essential. Every unit of money in the modern system exists because two sides agree on a relationship. One side owes, the other side is owed. There is no money without this relationship. The ledger view of the world. All modern finance is built on ledgers. Banks keep ledgers. Corporations keep ledgers. Governments keep ledgers. Central banks keep ledgers. Every transaction is a change in a ledger. One account is debited, another account is credited. Nothing physical moves, only records change. This is why money can be created and destroyed without printing or burning anything. It happens when ledgers change. Why trust is central to money. Because money is a record. It only works if it is trusted. When you accept a bank deposit as money, you are trusting that the bank will honor it. The system will recognize it. Others will accept it. This trust is not emotional. It is institutional. It is enforced by regulation, legal systems, central banks, clearing mechanisms. Without trust, ledger entries would be meaningless numbers. Assets, liabilities, and balance. Every financial institution operates on a balance sheet. A balance sheet has two sides: assets, liabilities. They must always balance. This is not optional. It is the fundamental rule of accounting. When money exists, it always exists as an asset for someone, a liability for someone else. There is no such thing as free money inside the system. Even when money appears to be created from nothing, it is created as a matched pair of entries. This is the key idea that makes everything else understandable. Why this feels counterintuitive. In daily life, we rarely think about liabilities. When you receive money, you do not feel like someone else owes it to you. You feel like you own it. But ownership in modern finance is not physical possession. It is legal and accounting recognition. Your money exists because the system agrees that it does. This is why money feels solid, even though it is abstract. Deposits are not stored money. One of the most important misunderstandings about money is the idea that bank deposits are stored funds. When you deposit money into a bank, the bank does not put it aside for you. The bank records a liability to you, an increase in its own balance. The funds become part of the bank's balance sheet. They're not reserved in a vault, waiting for you to withdraw them. This is why banks can operate with deposits far exceeding physical cash. Money as a system of promises. At every level, money is a promise. Payments will clear. Balances will be honored. Obligations will be settled. This system of promises is layered. Individuals trust banks. Banks trust other banks. Banks trust central banks. The system trusts legal enforcement. Because these promises are reliable, money works. And because they are recorded digitally, money can scale far beyond physical limits. Why creation becomes possible. Once money is understood as a ledger entry, creation becomes a technical process. Money is created when a new liability is recorded, a new asset appears simultaneously. Nothing needs to be taken from elsewhere. This is not fraud. It is how the system is designed to operate. The constraint is not physical supply. The constraint is confidence, regulation, and risk. A shift in perspective. When people say money is created out of nothing, they imagine irresponsibility. But in reality, money is created out of structure. It is created through accounting rules, balance sheets, and institutional trust. Once this perspective is clear, the next step becomes unavoidable. If money is a ledger entry, then banks do not need existing money to create new money. They need balance sheets. Looking ahead, in the next chapter, we will examine how commercial banks actually create money in practice. Not theoretically, not politically, but mechanically. We will follow a single loan from the moment it is approved to the moment new money appears in the system. And this is where the idea of money being created out of nothing becomes concrete. How commercial banks create money. To understand how money is created out of nothing, we must look directly at what commercial banks actually do. Not what people imagine they do, not what textbooks simplify, but what happens inside a bank at the moment a loan is approved. This process is not hidden. It is not illegal. It is the normal operation of modern banking. The moment money appears. Imagine a customer applies for a loan. The bank evaluates income, credit history, collateral, risk. If the loan is approved, something remarkable happens. The bank does not go to a vault. It does not search for deposits. It does not transfer existing money. Instead, the bank creates two entries on its balance sheet. One entry is an asset, the loan itself. The other entry is a liability, a deposit in the customer's account. At that moment, new money comes into existence. No one else's balance decreases. No physical cash moves. Money is created through accounting. The balance sheet mechanism. This is the core mechanism. When a bank issues a loan, its assets increase. Its liabilities increase. The balance sheet expands. Because assets and liabilities rise together, the balance remains balanced. This expansion is the creation of money. The borrower now has spendable funds. The bank now holds a claim on future repayment. Both are real. Why deposits are not a limitation. A common belief is that banks lend out deposits. In reality, loans create deposits. Deposits do not come first. When a bank grants a loan, the deposit appears automatically. Only later does the bank concern itself with reserves, liquidity, and settlement. This reversal of intuition is one of the most misunderstood aspects of banking. What actually limits bank lending? If banks can create money by lending, why don't they create unlimited amounts? The limits are not deposits, they are constraints. Banks are constrained by capital requirements, regulatory rules, risk management, profitability, borrower demand. Each loan carries risk. If borrowers fail to repay, the bank absorbs losses. This risk discipline prevents uncontrolled expansion. Capital, not cash. Banks must hold sufficient capital. To absorb potential losses, capital is not the same as money. It is a buffer. Regulators require banks to maintain specific capital ratios. If a bank lacks capital, it cannot expand lending, even if it has abundant liquidity. The crucial distinction. The role of reserves. Reserves are often misunderstood. Reserves are balances that banks hold at the central bank, are used for interbank settlement, payment clearing. Reserves are not lent to the public. A shortage of reserves does not prevent a bank from issuing a loan. If needed, reserves are obtained from other banks or from the central bank. This happens after lending, not before. From loan to spending, once the deposit is created, the borrower spends the money. Payments flow to other banks. Settlement occurs through the interbank system. At this stage, banks adjust reserves between themselves. The system absorbs the transaction without destroying the money created. The deposit simply moves from one bank's balance sheet to another's. Why this feels like nothing? From the borrower's perspective, money appears instantly. There is no visible source, no transfer from someone else. This creates the impression that money came from nowhere. But in reality, it came from a balance sheet expansion. The bank created a claim on the future. That claim is the foundation of the new money. Repayment and destruction of money. Money created by loans does not stay forever. When a loan is repaid, the bank's asset decreases. The deposit used for repayment disappears. Money is destroyed. This is as important as creation. Money enters the system through lending and leaves through repayment. The money supply expands and contracts based on credit activity. Why this system exists? This system allows economies to grow. It allows businesses to invest, households to buy homes, governments to finance infrastructure. Without credit creation, modern economies would be far smaller and far less dynamic. The system is not accidental. It is a deliberate design, a fragile balance. Because money is created through debt, the system depends on continuous repayment. If borrowers default en masse, banks face losses. This is where crises emerge. But under normal conditions, the system remains stable because obligations are met. Transition to the next chapter. Now that we understand how commercial banks create money, a deeper question emerges. If banks create money first and worry about reserves later, what ensures the system does not collapse? The answer lies beyond commercial banks. It lies with central banks. In the next chapter, we will examine how central banks support, stabilize, and control this entire process. Even when money appears to be created from nothing, it is created as a matched pair of entries. This is the key idea that makes everything else understandable. Why this feels counterintuitive. In daily life, we rarely think about liabilities. When you receive money, you do not feel like someone else owes it to you.